Excel accounting practice problem, void check and prior period adjustment. Get ready, because we're about to excel with Excel. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, we got two tabs down below, example and practice. The example tab in essence being an answer key. Let's take a look at it now. Also note that in prior presentations, we put this worksheet together from a blank sheet, which is a great exercise. So if you want to put that together, you can look at prior presentations. Now, we're going to be using this worksheet to look at and analyze the transactions related to the process of voiding a check, a process that can actually be quite confusing, especially if you're voiding a check in a prior period, which is a transaction you want to be very careful of. As we think about this process, it'll give us a better idea of being careful about changing things in a prior period, hopefully giving us a behind the scenes look at why that is the case. So we'll go through transactions, say down below. If you do a voiding of a check, say in accounting software, then you'll recall from prior presentations, the process of entering a check is the form that will be used oftentimes for any kind of decrease in the checking account. A similar form, even if it's a transfer or some other way that the cash account is going down, the check form will usually be used as the data input form to facilitate that transaction. The check form typically having then the person you're going to pay and then the account down below that will be impacted. Now, if you go through the voiding of a check in the accounting system, you could void the check, which in essence will reverse the transaction that you put in place when you entered the check, which might be necessary, for example, if you entered the check incorrectly or you've double entered a check, or if a check simply doesn't clear after some point in time, it got lost in the mail or something, and you're going to have to void the check instead of deleting it, you should void it. The idea then being that you're going to have an audit trail that will show you the activity that happened. You wrote the check and then void it. So if anything happens in the future, you'll have that audit trail as opposed to deleting the check, in which case you don't have the audit trail to tell you what has happened. So if you void the check in the current month or the current year, then you can reverse it pretty straightforward. But if you void a check in a prior period which has been closed, for example, a prior month or even more significantly a prior year, then you have this problem that you're doing something to a prior period and you've got to be very careful, and we'll try to get into why that would be the case. If you were trying to void something in a prior period, say in accounting software, it might then give you an option to basically make things work out properly, saying, hey, look, if you void that check, what we'll do is we'll zero out this check. We'll tell you that it has been voided, so you have the audit trail, and then we'll enter a journal entry. This is a journal entry that's basically putting the check back in place. I wrote a very large check so that we could see it. That would be the $100,000 here, decrease in the checking account, and then it goes back to the test account, which is an expense account, just an example account. And then it's going to make another journal entry. This was as of the prior period. In this case, 2023 was the current year. Prior year was 2022. So it did that, reversed it in the same prior year. And then it recorded this transaction again in the current year, which is increase in the checking account, and then recording a negative amount or decrease in essence, the expense account to void the check completely. So to void the check in a prior period, in other words, it voided the check, zeroed it out, and then it compensated for the fact that it was a prior period adjustment by making an entry that basically put the check back in place as a journal entry. So now you could see that it had been voided, but then it basically replaced it. So your retained earnings or your balance still rolls over correctly. And then it entered another journal entry to kind of do the voiding process in the current period. Okay, so that can be quite complex. Let's do that with journal entries up top and see why this is the case. So I'm going to go to the practice tab now. And the first check we're going to think about is one where it's in the same period, pretty straightforward kind of voiding process. So if I was to say, for example, we had a check and the check was for miscellaneous, let's say the checking account went down. We're just going to record a check that we paid for some miscellaneous expense. So I'm going to say, all right, the checking account's going to go down. That's what I'll think about first because I know the checking account goes down with a credit. I'm going to say it was for $1,000. So there's the debit and the credit for $1,000. And the other side, we're going to say went to the account of miscellaneous expense. We put it to miscellaneous expense, our favorite account. We just put everything to miscellaneous expense. And then we're going to go home tab, alignment. Don't put everything. That's not a good idea. I'm just joking there. But in any case, now we're going to then record that. We're going to say, all right, so we record that. It's going to go down to miscellaneous expense. That's going to go up when we write the check. So that's going to say that went up. And then, so that went up from 600 to by 1,000 to 1,600. Other side going to the checking account equals the checking account. 1,000 checking account then goes down. If I post this to the general ledger, we're going to go all the way to miscellaneous, which is like somewhere in the middle, right in the middle of the expenses. So it's in the same order of accounts. We've got assets in green, liabilities in orange, then the blue for the equity, revenue, and expense accounts. We're looking for miscellaneous. It's right down here in cell AM17. So I'm going to say this happened on 115. I'm putting my cursor in AN17, selecting equals, holding the left arrow down till we hit the wall. There we're at the wall, scrolling up, last transaction, there's the 1,000, or you can memorize that it's in cell C2 and just simply type equals C2. Now we went from 600 up by 1,000 to 1,600. That 1,600 should then be on the trial balance. Let's check it out. It is indeed there. That's good. And we're out of balance on the GL till we record the second half, which is to the checking account, which is our first account right here in K5 115. This is going to then be equal to that 1,000 decrease to the checking account, the 100,000 going down by 1,000 to 99,000, that 99,000 matching what's on the trial balance, the general ledger back in balance. Now, if we're going to void that one and it was in the same time period, then we could say, okay, now the check didn't clear, or I shouldn't have wrote it, or it got lost in the mail, and so on, so I got to void the check. So then we could say, okay, well, 115, the journal entry for it, if you did this in accounting software, what you would do is you would go to the check and you'd select void the check, and if it was in the same period, then you don't have a big problem with it as long as it was a legitimate voiding of the check. It was a check that needed to be voided, and it would simply reverse the transaction, but do so by giving you an image of the check, so you could still basically go into that check and see that that check was voided, and so you have an audit trail instead of deleting it. So to void the check then would be another journal entry. We do it with a second journal entry. In other words, I'm not just going to delete this journal entry up top. Usually I would want to do another journal entry to kind of show the audit trail if I'm looking at this from a journal entry by journal entry standpoint. So I'm going to say that we've voided it. And I'm going to put the void, I'm going to say the void is going to go back to the same day we wrote the check. So even if it's like I'm voiding it a month, or 5 days later, it's going to basically void it and reverse the transaction basically at the day the check was written. So because it was kind of erroneously written. So we're going to say, then I'll reverse this checking account up top. It's going to have to go back up because it never really went down because the check's not going to clear. And that's going to be for the 1,000. And then the other side is going to go to miscellaneous. This is the rare event where we're going to be crediting an expense account because we incorrectly debited the first time. And that's when we're going to credit the account just to basically reverse it out. Posting this out, and I'm going to call this the void transaction for the memo void. And so we'll record this. So now I'm going to go checking account's going to go back down, double click in the checking account, go into the end of it, plus that 1,000, it goes back up, to 100,000. And then the other side's just going to match out against the miscellaneous expense, double clicking it, going to the end of it, plus pointing to that 1,000, and that then goes back to what it was at the 600. Let's record that in the GL. In the GL, we're going to go to the checking account on 115. I'm going to say this equals then the 1,000 debit. So you can see now we're back to the place we started at. So why didn't I just delete it? Because I want to see that I wrote the check and then voided the check. And we could do that in the accounting software by having the form indicate that that particular check was voided. And then we're going to say that the other side is going to go to miscellaneous. So we're going to go to miscellaneous assets, then liabilities, equity, and then the income and expenses. Here's miscellaneous. So I'm down in AM18, 115. We're in AN18. I'm going to say equals, hold down the left arrow till we hit the wall. And then we'll scroll up to the last transaction. we're looking at that miscellaneous at the 1000. It's in D6. You could also simply type in equals D6. So once again, we're back to the starting point. 600 went up to 1,600, down back to 600. That 600 should match what's on the trial balance now. There it is, and it should match up top. We're back in balance on the GL. Okay, now let's do the more complex situation. We're going to say, this is the transaction we're saying it happened last year. I'm going to indicate that by prior year because I don't have my years and my date ranges. So I'm going to say this happened prior year. I'm not going to record it right now because I'm going to assume it was recorded last year. And I'm going to say it was recorded to office supplies. We're going to say office supplies and the checking account. Office supplies and the checking account. And we're going to say it was for $2,000. I'm not going to record it. I'm going to indicate that it was a prior year transaction by making this a different color. And I'm not going to post it over here because it's not a current year transaction. That's the thing we need to void in the prior year. So I'm going to hit the colors up top. I'm going to make that like this color is what I made it on the example. Something like, how about this color? Like that. Okay, we'll make it that color. Okay, so there it is. And so now we got to void that. But now that happened last year. It happened last year. And I'm gonna indent this. So if I void the check, like if I wrote this check and the check was in there for last year and I void it, then the system's going to void it as of when the check was written, because it's going to say that the check was basically wrong, and it's going to void it as of the prior period. Why is that a problem? Because this supplies account was recorded in the income statement in the prior year, and then it rolled into basically the equity, which would be like retained earnings or the capital account if it's a sole proprietorship. And so if I delete it, I'm going to mess up the equity account. My equity's not going to roll over properly. So that's going to be basically the problem. I can't just simply reverse it, but I want to void it, but I can't simply reverse it. So how do I deal with that? Well, one way you could do it with journal entries would be fairly straightforward. If it was a journal entry transaction, I'm going to say undo that. What did I do? I don't know. I'm going to say then we're going to say we're in the current year. Let's say 115 in the current year. So now we're at the current year, and I need to basically void that prior year transaction. So it would simply be then that the checking account is going to go up by that 2,000, and then the office supplies is going to go down by the 2,000. And I'm going to say alignment indent, but this is happening in the current year here. And with journal entries, I can record that in the current year because I'm recording in the current year's time period. But in the accounting system, like if I was to do this in QuickBooks and I voided the check, I can't void the check as of the current year. So that's kind of the problem. So if I did this with journal entries, it'd be straightforward. I could say, okay, I'm just going to record this as of the current year. And I'm going to say that the checking account then is going to go up by that 2,000. So it's going to go up by the 2,000 here. And I'm not going to mess with anything in the prior year. I'm not going to mess with the equity account, but I'm going to record the negative amount to office supplies in the current period, which is going to be down here in office supplies, which makes a negative office supplies, which looks funny. How could it be a negative office supplies when I increase the office supplies with this check? Because this 2,000 cleared into the equity section and is no longer represented in the current year's numbers down here. So I end up with actually a negative amount, which is kind of correct, because what I'm doing is compensating for the fact that the prior year was off. But instead of going back and adjusting the prior year, because if I was to do so after having finalized the financial statements, my retained earnings account won't roll forward. So I have to make the adjustment to the temporary accounts in the current period, because that's going to be the easiest thing to do to basically move forward without having to reissue prior financials or something like that. So then we'll talk about it. So we'll record this, and then we'll do one more step, a little bit more complex, to see what happens in QuickBooks or in accounting software as to why it would record these multiple transactions. So this one, then we're going to say, okay, if I reverse this, then I'm going to say it reversed as of, we're going to say 115 again. And this is going to be equal to the checking account's going to go back up. And then the office supplies we said was in office supplies is over here. assets, liabilities, equity, and then expense accounts. Office supplies on 115. I'm in cell AR5. We're going to say equals. Hold the left arrow down till we hit the wall. And then we're going to scroll down to that office supplies, that 2000. So again, the office supplies only had 490 in it. We took it down 2000, making it negative, which is funny for an expense. And that's because of that timing difference that we're reversing something that happened in the prior period. Okay, let's do it one more. Now we're going to do one more, and we're going to do it and say, well, why does QuickBooks do this? Like if I did this in accounting software, why does it do this funny journal entry type of process? Let's see if we can simulate that and see what's going on there. So now let's say that this happened on 215 or 225 in the prior year. So this is a prior year check again. Prior year check, and let's say this one was for the telephone company, and the other side is the checking account. Now I'm not going to record this again because this is something that we're going to say happened in the prior year. We're going to say it's for $400. So there we have it. So there's our transaction. I'm going to make it this color. I'm going to indent it and make it that funny color again to indicate that that's a prior year transaction that we're trying to void now. So when I void it, we're going to say, like if I void it and I used the form to void it, then I don't have the option like I did up top with a journal entry of just entering the journal entry in the current year to kind of fix it. Because notice if I do that, even with a journal entry, I can't really see that last transaction in the detail was kind of wrong. But I am going to fix it in the current period. What I'd like to do is indicate that this transaction is basically wrong. It's not cleared. It was input improperly, and I need to void it, even though I'm going to compensate for it in the current period and not go back and adjust it in the prior period. So this check, if I was to void it, then is going to void as of the prior period, and so I've got to compensate for that. So in other words, if I was to say let's void this, and I'm going to do this as of the prior period, which would be 225, but I'm going to record the transaction that would be resulting that you would see in the current period. What would be the impact on our current trial balance if I was to record this in the current period, just to show what's going on here? So we're going to say that would mean the checking account. The checking account would then be going up, and the other side would be going to, I'm going to call it equity, and then I'm going to call it telephone expense. In other words, I'm going to indent this. In other words, what's happening, this happened last year, prior year, if I was to reverse it, but the impact on the current year would be that the permanent account would still be impacted because it's not changing, it's not closing out, as we call it. And the telephone account, this expense account, would now have rolled into the equity. So this transaction that we reversed in the last year would have the impact on the current period's trial balance of this. I'm gonna record it so we can see it here. Double clicking the cash account, the cash would be going up by that 400, which is correct, but the other side would be going to equity. It would be going to equity here. Why? Because it would have hit the telephone company account or the telephone expense account last year, and then last year's information would have rolled into equity, resulting in kind of my beginning balance in equity not matching anymore the ending balance of the prior year. So I'm not going to record that into the general ledger because this is actually something that would happen the prior year. I'm just trying to show you how the current year would be thrown off because the permanent account would be correct, but the temporary account would have rolled into equity, so the impact would be on equity. That's the problem. So then if I voided this check, then we'd have to reverse it. I want to reverse it as of the same date, as of the prior year, so that I can see the audit trail, but still reverse it as of the prior year. Therefore, I have these two transactions right next to each other to show the voiding of the check. And then I'm going to record the reversing of it, which is going to be as of, I'm going to say the same date, 225. And I'm going to reverse this exactly. So I'm going to say this is going to be the equity account, and this is going to be the checking account. going to be for the same $400, the same $400. To reverse it, I'm going to indent this. And so I'm going to reverse this exactly. So I'm going to record the equity account, double click in here, and then go plus, and then record that $400 in the equity, getting our equity back to where it should be, because we closed out the equity. We don't want the equity to change because we already closed out the prior period. But now I'm going to record the other side to the checking account, which is going to make it wrong again. So I'm going to record that to the checking account. Now, it is wrong. These are two transactions that would happen in the prior year, but this is the impact, in essence, in the current time period. That's why I'm not recording it to the GL, because this really happened in the prior year. I'm just trying to show the impact of it. And then I'm going to record another transaction, which would be this final transaction over here in the software that might do that automatically for you, which will record it in the current time period. So now I'm going to say in the current year, let's say it's 3/15 that we determined that this check needed to be voided. I'm going to record it again, which is in essence going to be the checking account for the $400. And the other side is going to go now to the telephone expense actually in the current time period, negative $400, indenting this item. So now we're going to say the checking account, scrolling up, we're going to fix it again, double clicking on it, end of it, plus the $400 in the checking account. There, now it's back to what it should be. The telephone expense now is reversing negative, going down, which is unusual in the current time period to adjust for the error in the check last period. This equals the $400. So it goes from 2007 down by 400 to 2003. Let's post this to our GL. This one we're going to post to the GL. These two I'll indicate that are not posted to the GL by making them green. I'm trying to indicate that those are prior period adjustments, that we're trying to just see what the impact was and why we're doing what we're doing. And then we're going to say that this is going to go to the checking account on the GL, which is going to be, I said that was on 3/15. 3/15, this is going to be equal the checking account for that 400. And then the other side going to the telephone expense, which is second to last account. So it's in order: assets, then liabilities, then equity, income, and expense. We're going to the second up to the last account on 3/15, we said. 3/15, we're in AV5. This equals, scrolling all the way to the left, scrolling down, we're going to be picking up that $400, enter. So now we got the 2007 going down to compensate for the voided check that happened in the prior period to 2003. That 2003 should be what's on the trial balance, as we could see down here, and we're back in balance up top here. So let's see if we can recap this now. This was the original check that was entered in the prior period. We would like to have the voiding of that check because it was improperly input, even though we didn't discover that until a later accounting period. We would like to have the transaction right next to when the actual check was entered. So we're going to enter this transaction below. This transaction then would actually be entered in the prior period if we were to void the check in the accounting software, and it would be going to telephone expense. However, that's a problem because when it goes to telephone expense, it rolls into equity. So the impact on the current year is the fact that our equity is now incorrect. We can't change equity because we already finalized the financial statements in the prior period. That's where the problem is. And this is accomplished and giving us the audit trail when we void the check. So if I was just to void the check, then we would have the check still there, but voided, giving us the fact that we have that kind of connection between the check and the void that took place. But we've got this problem that it messed up now our equity account. And so therefore what we're going to do is reverse it with basically a journal entry. So we'll reverse it as of the same time period, which you might say, well, that's redundant because now I just put the check back in place and we're back to the same place we were at before. We are, but we have this audit trail, and that's why we did this. We voided the check to show it's voided. Then we put the journal entry, putting us right back into the same place as of the same date when we put it back in place here. But then it gives us the audit trail, and then we're going to enter another journal entry as of the current date, as of the current time period in the current year, which will basically then reverse it as of the current time period, which is what we want to do. And that would be increasing the checking account and then having this negative expense account. And so that would mirror, in essence, the check being voided, which would reverse the transaction in the prior period, then putting the check, in essence, back in place, but with a journal entry to show the audit trail, and then putting another journal entry in the current time period so that we could then record it back on the books in the current time period instead of a prior period adjustment. Now, also note that when you do this, you're going to say, okay, well, wait a second, because now I've got, if I was to look at the checking account, I've got this, and this, going into the checking account, and these items would net out basically on the checking account. So when you actually do the bank reconciliation, you're going to have these multiple netting transactions that are going to have to net out so that you reconcile, the bank statement and the bank reconciliation process.